Ultra Clean Holdings just lost 18% of its value in a single trading session. That is not a dip, that is a controlled demolition. Here is what separates a sophisticated investor from everyone panic selling right now. Understanding whether the market just correctly repriced a deteriorating business, or whether a crowd of algorithms and retail traders just handed you a discount on a structurally sound company. That is the exact question we are going to answer today, using the actual numbers, not the headlines. Let's start with the mechanism, because the headline number tells you nothing useful on its own. Ultra Clean Holdings is not a chip designer. It is not a fab. It is a critical path supplier, the company that manufactures the subsystems, gas delivery modules, and chemical delivery components that go inside the machines that make semiconductors. Think of them as a Tier 1 supplier to companies like Lam Research and Applied Materials. When those primes sneeze, UCTT catches pneumonia. What moved the stock on July 3, 2026 was a combination of forward guidance that came in materially below consensus and a broader read-through from cautious commentary in the semiconductor equipment space. When a company in UCTT's position signals that customer order timing is shifting, meaning big fabs are pushing out capital expenditure cycles, the market does not wait around to see if it resolves. It reprices immediately and aggressively. Here is the structural reality that most retail investors miss. Capital equipment suppliers like UCTT carry extremely high revenue concentration risk. A relatively small number of Tier 1 customers account for the majority of their top line. When even one of those customers delays a tool order by 1 or 2 quarters, it flows through to UCTT's revenue in a way that is both visible and painful. The 18% drop is the market embedding that delay risk into the share price all at once. The actionable insight here is straightforward. Before you react to any single-day crash in a supplier name, the first question you ask is this guidance miss a demand destruction story, or is it a timing shift story? Those two scenarios have completely different recovery trajectories, and conflating them is how investors lose money twice. Once on the way down, and once by selling before the recovery. Now let's interrogate the move itself, because 18% in one day demands scrutiny in both directions. The question is not whether the news was bad. It clearly was. The question is whether the magnitude of the repricing is proportionate to the actual change in long-term business value. First, look at volume. A heavy volume down day is critical information. It tells you that institutional holders, the people managing billions who do not sell on emotion, made a deliberate decision to reduce exposure. This is not casual. When funds exit on volume, it typically means portfolio managers received the guidance update and ran their revised models, and the output told them the position no longer fits their target return profile at the current weight. That is rational, not panicked. And it means the selling pressure may not be exhausted after a single session. But here is the counterweight argument. UCTT is a cyclical business operating inside one of the most structurally important industries on the planet. Semiconductor capital expenditure cycles are not linear. They compress and expand based on fab utilization rates, geopolitical supply chain strategy, and memory versus logic CapEx mix. The current cycle in mid-2026 has been choppy precisely because AI-driven logic demand is pulling capital one direction while legacy memory oversupply is pulling another. UCTT sits at the intersection of both, which creates noise that can look like signal. An 18% drawdown on a supplier with UCTT's operating profile is not unprecedented. In prior cycle troughs, the stock has seen drawdowns in the 30 to 50% range from peak before recovering sharply when CapEx reopened. That historical context does not guarantee anything, and this is not financial advice. But it does tell you that extreme single-day moves in this name are part of the operating environment, not anomalies. The institutional lens says the sell-off is justified in the short term. Whether it's overdone depends entirely on how long the CapEx pause lasts. If you are newer to markets and you owned UCTT going into today, this session probably felt like a gut punch. Let's extract every useful lesson from this, because a single well-understood loss is worth more than a dozen unexplained wins. Lesson 1. Supplier economics amplify volatility. When you own a component supplier rather than a finished product company, you are taking on leverage to the end market's CapEx decisions that happen behind closed doors at Intel, Samsung, and TSMC. The reward for that leverage is that when cycles turn up, suppliers can run hard. The cost is that when cycles pause, the punishment arrives fast and without much warning. Knowing what kind of company you own before you buy it is the most basic form of risk management. Lesson 2. Guidance revisions are the most dangerous document in a cyclical company's earnings release. Not the revenue miss, not the EPS. The guidance. Because analysts build models on forward numbers, and when those forward numbers move down, every price target built on them moves with it. Automatically. Simultaneously. That is the mechanism behind a synchronized institutional sell-off, and it is why the stock does not fall 4%. It falls 18%. Lesson 3. Position sizing is your only real protection in volatile sectors. If a name like UCTT represents 2% of your portfolio and drops 18%, your portfolio moves 36 basis points. Painful, but survivable. If it represents 15% of your portfolio, you just had a bad month in a single morning. Semiconductor suppliers, biotech, and early-stage growth companies share one common trait. They require smaller position sizes than their upside potential makes you want to give them. That tension is where most individual investors lose discipline. Finally, use moments like this to audit your thesis. If your reason for owning UCTT was exposure to AI-driven semiconductor CapEx growth, the question today is whether this guidance miss changes that thesis structurally or simply delays its timing. If the thesis is intact and position sizing is appropriate, a drawdown like this is data, not a directive to panic. We open by asking the one question that actually matters in a moment like this. Rational repricing or crowd overreaction? The honest answer is both, depending on your time horizon. Short term, the institutions are telling you something real. Long term, the semiconductor CapEx cycle has historically rewarded patience. The follow-up question, and the next video, is what the leading indicators look like for the next CapEx expansion and which supplier names have historically led the recovery. Subscribe so you don't miss that analysis.